I'm Dave Codre. In this video, we're going through the third quarter performance of the Greenleaf Opportunity Zone Fund. We launched this back in 2019 with 6 deals to really take advantage of the renovation projects we were working on at the time. Last quarter, we spoke about how the Opportunity Zone map changed a little bit. There were, some Opportunity Zones got bigger, some got smaller. We were hoping we'd be able to find a few new opportunities because of that. That didn't pan out in the third quarter, so we didn't add any new deals. We were a little optimistic there. The other main point we talked about was the eviction moratorium. And this expired at the end of August, the federal eviction moratorium, that is. Since then, we have seen our residential delinquencies start declining, so that has been positive news on that front. All right, so what are we going to talk about in this quarter? So now in the third quarter, we're going to dive into our renovation schedule, seeing how we're tracking on all of the projects. We're going to go through our operating results to see what the performance looks like on a day-to-day cash flow basis. We're also going to touch on the fund valuation. So we're going to go through where we started all the way up to today and what the market is saying about the value of our deals. The last thing we're going to touch on is what we call the sale refi decision. And this is really anytime we come to a loan that's expiring on an asset, we go through and determine what the best source and uses of capital are for that asset. That's going to start happening on all of our deals as we exit this renovation schedule. So we're going to go through that process and what it looks like for the fund. On the renovation side, all of our residential deals are now completed. The last one we wrapped up was Heritage, but Heritage, The Grove, and Fairway, those are all fully done. On the commercial side, if you recall, we have 3 assets: the Station, 1500 North Graham, and the Lupton. Now, 1500 North Graham is the one that we finished this quarter. We also posted some other videos on just what the interior pictures of that are looking like now. The Station has been done for a while on all the shell and core. We still have some vacant suites that we're working on leasing, but all the CapEx is done. The remaining project is the Lupton. We were trying to have this project completed for June of this year. The main part we're waiting on right now is windows. We have a lot of windows on the outside of this building that we were looking to open up the window sizes and make them a lot larger and put all new windows throughout the whole thing. That's been delayed. It continually gets pushed back a little bit. So right now we're looking at the end of 2021 that we'll have these windows in and then installed in the first quarter. So that part of our renovation schedule is running behind. We're working on getting them in as best we can. But that's the last part. Once that happens at the Lupton, we will be completely finished with all renovation work in our QOZ fund, and we are going to heavily shift from a renovation mindset to an operating mindset. When we look into our operating metrics, first we're going to start with the residential side of the fund here. In these 3 assets, we actually saw an occupancy decline in the third quarter. We were at 95% the end of the second quarter, and throughout the third quarter, we dropped to 92%. Most of this drop was actually at Fairway Apartments, and the majority of residents who left were really our long-term delinquent residents associated with COVID who post-eviction moratorium are now vacated. So that is actually helping our delinquency balance decline, but then we saw the occupancy decline because of that as well. As we go into the revenue side, we had about a 3% drop in revenue, really tied to this occupancy decline. So we went from $476,000 to $460,000 on our quarterly revenue. Now on the goal side, our goal is $150,000 a month in revenue, and that's what puts us right at our cash flow positive point on the residential side of the business. So we were still above that, and we were cash flow positive for the quarter. That's our second quarter in a row that we're cash flow positive, and that's really a big deal as we shift from a renovation mindset on our properties over to an operating mindset. We really want to see that positive cash flow. So that's what enables deals to be successful. And in this case here, we have 3 assets that are cash flow positive and performing well going forwards. Now let's jump over to the commercial side of the house. Here we're seeing positive momentum in the small tenant space. So we have 3 assets, of which the Station is the only one that really has any current tenants. And here we saw occupancy gains. So while we're not where we want to be, our target was 50% for this quarter. Right now we're sitting at 38%. The main way we're going to get there is really leasing up 1500 North Graham to start with, and then following up with the Lupton. So at North Graham, we do have a couple LOIs. We've been speaking to a few tenants. Some of them didn't work out from basically the tenant type and how that would apply to the larger building. For example, we had some event-based tenants that wanted to use it, but that doesn't really tie in if we're going to have other professional service groups there or medical tenants in that location. So we really have to be careful of the first tenants we put in there. They have to be a good fit for the other tenants that can also fill in the suites there. So we have 5 suites, and we got to make sure they all are cohesive to work in that area. So some of those first tenants didn't work out. We're currently talking to some medical groups about taking some of the space. That would be a huge positive for the asset. So we're really looking at that route first. On the revenue side for commercial, we saw a jump here. We are having occupancy gains, so we're seeing pretty consistent, small by small growth each quarter of revenue. If we look back Q4, Q3 of 2020, we were in the mid $190,000 a month range. Or really, this quarter we hit $232,000 of revenue. That's the best quarter we've had on a revenue standpoint for the commercial side of the house. So that's very exciting for the fund as well. Now, when we look at things overall, so we tie together residential and we tie together commercial, we had our best income performing quarter that we've had so far. The chart here really shows some ramp up as we came out of Q4 2020 and the first quarters of this year. That was really our initial occupancy growth on the residential side, and we expect to see another push as we get 1500 North Graham and the Lupton Building leased up in the coming quarters. On the fund value, we're going to break things up again between the residential and the commercial side. They both have different valuation methods that are used to get to a current value for the assets. Now on the residential side, this one is driven by cap rates and it's driven by cash flow. The cap rates on the residential side are in that 3 to 4% range. This is a lot of the reason why we haven't bought a whole lot of residential assets currently. When we take our current cash flow, we apply that 3 to 4% cap rate. The other aspect that we're looking at is just offers that we get. We're continually getting off-market offers. We put in our offers that we receive, we compare it to what the market cap rate is looking like, and that gives us our general estimate of value. We're not going out and getting full appraisals for what this stuff looks like. So right now, when we look at the 3 residential assets we have valuations, and on a per unit basis, Fairway's about $110,000 a unit, Heritage $125,000 a unit. We had offers at that price, and the Grove were there sitting around $100,000 a unit. So if we put all those together, we have the 3 asset values totaling around $23 million. Now on the commercial side, it's a little bit different. Here, cash flow is important. We're always looking at cap rates, but tenant mix is a big factor in that, and then price per square foot. So here we have 3 assets with a wide range of price per square foot on that valuation. The lowest is the station. We have over 60, 70 tenants here, and it's very much a mix of tenant types. So that kind of compresses the price per square foot, especially the submarket that it's in is not a higher value submarket. So here we're at around $83 a square foot is what we're seeing the value at. When we go over to the Lupton, even though there's not tenants there, we're seeing that market, which is right downtown Chattanooga, pegging that around $118 a square foot, and that's really taking into our account our basis. We don't have a whole lot of value creation there yet because we haven't signed any leases. And then at North Graham, this has been a higher quality build out, really just what the interiors look like, a nicer building in a much more expensive part of town where it is in Charlotte, the NODA area. So we see values over $200 a square foot in this market. So we put that together on the commercial side, we're looking at a fund value of about $22 million. So add commercial, residential together, we get our total asset values of about $45 million. Now, when we back out equity, we go through our capital stack of what that looks like. We've essentially earned roughly 50% on our ingoing equity to the QOZ Fund, which was just over $12 million. So we've earned about half of that up now through the valuation gains we've received from heavy renovation work, big lease ups, and really turning around these assets, taking them from a renovation to operating platform. So we're excited about that value gain there. That's really what we're trying to do in the QOZs, really turn these properties into something that's producing cash flow, stable operating assets. The final part we're going to walk through now is the capital analysis. And we're really assessing sale and refinance opportunities within a specific asset. Now we do this asset by asset because it really depends on when the loan is maturing. We look at Fairway Apartments. This loan matured back in November of 2020. So at that time we refinanced. We used Freddie Small Balance Loan Program or Freddie SBL. We secured a 10-year loan at 3.67%. So that loan is locked through the end of our QOZ hold period, which is 10 years and ties to 2029. The loan goes to 2030, so it's a little bit past it. But when we look at Heritage or the Grove, those loans are expiring in February and March of 2022. So therefore, we're going to be looking at what are our options from a debt standpoint. We want to try and have the max amount of revenue to get the max amount of debt that the deal can safely afford to pay and make sure our debt service coverage ratios are still above that 1.3, 1.4 range. They'll drop to 1.25 on the loan terms, but we want to have a little bit more than that to make sure that we can hold and improperly service everything that's there. So individually, as we go through it, deal by deal, we don't have those right now, but as they come up, we're going to do separate live streams on that and go through each specific analysis. Now, on the commercial side, it's a little bit different. Residential, we can go get a 10-year loan because it's just everything is annual leases with residents there. But on the commercial side, the loans are very much tied to our weighted lease term. It's known as WALT, essentially, weighted average lease term. And on North Graham and the Lupton, as we lease those assets up, we're really focusing on getting longer-term leases so we can secure longer-term debt. If we sign leases that are 2 or 3 years, we're really only going to end up with a 2 or 3 year loan. We're going to be in the same position pretty quickly. So we want to try and get longer leases to enable longer-term loans and lock in the best rates we can. We're always watching the 10-year, making sure we're on top of what's going on and locking the best rates we can. It kind of seems like debt's just getting cheaper and cheaper. For the short term, we're kind of thinking that rates do rise, but we've been saying that for a long time and that hasn't happened. So we still are trying to lock lower rates for as long as we can. And we're going to be able to do that with longer leases. So each time we have one of these come up, basically even on the residential side, on the commercial side, we're going to do a separate analysis on a deal-by-deal basis and make sure we get the best refinance that we can. All right, that is it for the third quarter. Please let us know if you have any questions on the QOZ Fund or anything that we're doing here. And thank you very much for watching.